So the first school of thought, then, is a severe recession. But although slow, we're on a way to recovery. And this is the U.S. Federal Reserve Bank's view of what's happening, and obviously the Obama administration and the Congress of the United States. So first of all, we have the idea that macro policies are working. We've had aggressive monetary accommodation to try to eliminate the zero lower bound problem. In economics, we always can manage monetary policy by changing interest rates or money supply. But when we have a positive interest rate, then it's easier to measure what the real rate is in the economy. When it's the case we have a zero interest rate in the economy as we do in the United States and in Europe and generally Japan, other countries of the world, that it's very hard to know what the real rate is, because once the rate goes to zero, then you don't know really the real rate behind that, because if we have deflation, that's the prices falling, then obviously the more prices are falling, the higher the real rate is, because just by holding cash, you're making lots of money. Because prices are falling, you hold cash, that's a very high, could be a very high rate of return. So as a result of that great worry of the monetary authorities around the world, the zero lower bound problem, that they have pumped in the United States a tremendous amount of liquidity into the system and increased reserves in the banking system dramatically. And as well as when they reduced interest rates to zero, they have been buying very less liquid assets, such as mortgages, to the tune of about $1 trillion. So the idea that the United States Federal Reserve Bank is trying to restore health in the banking system and investors' health as well, their wealth, by keeping interest rates at zero at the front end of the curve and by what's Operation Twist. Also, we've had quantitative easing programs. By the way, the Federal Reserve uses language which sounds mathematical, but it's not really. QE1, QE2, and currency swaps, Operation Twist, etc., are ways of them to buy securities in the market, which when you buy securities, the Federal Reserve actually prints money to do it or sets up deposits to do it. And the idea of setting up deposits is to allow for more liquidity in the system, hoping that the banks will lend that money out and then create a multiplier effect in the economy. The Federal Reserve balance sheet prior to the crisis was about 500 billion US dollars. It's now grown to 4 trillion. So some of us in the US say the Federal Reserve Bank is probably one of the largest hedge funds in the world at this time. And actually, with only 85 billion of capital and a $4 trillion balance sheet, there's a possibility that if interest rates were to go up unexpectedly, that I estimate that the Fed could lose about $1.25 trillion US dollars. And that is hard to do unless you're the government itself, I guess. But what we mean by helicopter money is that if the government is buying bonds in the market, then it's quite similar to the idea of trying to just drop currency around and people pick up the money and spend it accordingly. And that's possibly what the government, the Federal Reserve, they will do, in the sense that they buy bonds and then with quantitative easing, they have the intention of reselling them sometime in the future if they can sell them sometime in the future. Now we have, at this time, we have Ms. Yellen, who is going to replace Mr. Bernanke as chairperson of the Federal Reserve Bank, if affirmed by the U.S. Congress, which I think that she will be with some fights by year end. Her view is, and the view of others, is that the policies that were instituted by Mr. Bernanke and the other members of the Federal Reserve, although they provide a lot of liquidity to the system, a lot of money to the system, that really what they did by forcing interest rates to be so low and by buying bonds in the market had caused investors to move from the bond market to the stock market or to foreign markets to garner higher yields. And as a result of that, increase the wealth of some of the citizens of the country, namely those who are holding stock and foreign assets, and did not really do that much to stimulate jobs in the economy. So that quandary that we have now in the United States is, can the Federal Reserve Bank do more to make the economy recover? Because the recovery has been very slow in the United States. And so I think Ms. Yellen will move to a more aggressive policy than what the policy that Mr. Bernanke has been using, and to move away from this wealth effect that I talked about to one of targeting nominal growth rates in our GDP and GDP. So right now, the way the Federal Reserve Bank works, or economies work around the world, is the central bankers, who all talk to each other, by the way, so the policies are not that distinct, assume that they'll target a 2% inflation rate, okay, and that they'll try to be aggressive up to using policies that will support the growth economy, but not to exceed the 2% inflation rate. So the new way of thinking about it, which I'm not going to say is going to work or not work, because it does rely on a little bit of magic, which I really don't understand. But the idea is, if you say we're going to target nominal GDP, so instead of our growth rate in the economy being, say, 2% or 3%, and then having a nominal inflation rate of 2%, so we'll have a 5% growth rate in total, what we'll do is we'll say we're going to target a 6% nominal growth rate. And so the composition of the growth rate, the proportion that's inflation with the proportion that's real growth in the GDP is combined into one number. And so this is, again, moving into uncharted waters. But now you're going to hear in the future, and you're reading in the papers over the next number of months or the next year, you're going to hear about something called optimal control. These are optimal control of monetary policy. And what it means, optimal control, is essentially the Federal Reserve Bank will set a loss function, and they'll do simulations of various paths of the interest rate to see what the growth of the economy will be in combination with inflation based on their models and their assumption. And they'll pick the path that maximizes their utility as to how they want to run the economy. Now, if you look at the green line, what the optimal control policies are saying, and I took this from the Federal Reserve Bank publications itself, is that you see on the top graph, or the top figure, that under the Taylor rule, which is a way they are currently managing their policy, which sort of targets this 2% inflation and also growth rate in the economy, that under, let's say, the 1999 Taylor rule model, and they've adjusted it over time, would have interest rates at zero sometime in the United States, sometime into 2014. But in the optimal control model targets, it means that they'll keep interest rates at zero closer into 2015, and obviously could be changing in the future. So the talk that we've heard of the Federal Reserve tapering or stopping their bond purchases under a Yellen model would be deferred for a much longer time period. And the interesting trade-offs that we see are in the two bottom graphs. One graph is the unemployment rate. So under the control model, they think that they can make the unemployment rate fall faster by allowing for the interest rate to not be increased for a longer period of time at the expense of the green line of having higher inflation than the current policy. So there's a trade-off. This is called, in a lot of ways, the Phillips Curve, which has somewhat been disputed as not really working, but all macroeconomists who believe in the Keynesian view, and that includes Ms. Yellen, who's a graduate of Yale, and also James Tobin, a student, really believes in these trade-offs and the idea of policy. So what it means for U.S. policy going forward is actually having lower interest rates to stimulate more growth in employment, reducing the unemployment rate, and giving up something more on the inflation rate. And then current policies that are in place under Mr. Bernanke as chairman of the Federal Reserve. So the Federal Reserve policy, I think,